Welcome back to the deep dive. If you've been watching the financial news cycles lately, you are probably feeling whiplash.
Well, absolutely.
I mean, the markets are just this constant screaming churn of volatility, red
Yeah.
candles, green flashes, panic headlines all over the place.
Right. And you're told to worry about inflation 1 minute.
And then deflation the next, all while you're just being bombarded by this relentless, crippling sense of information overload.
That feeling, that exact confusion, is precisely the environment where the real signal gets lost in all the noise.
Yeah.
Wall Street, they rely on that confusion. They want the retail investor completely rattled, looking everywhere but at the long-term strategic moves that are actually reshaping the whole financial landscape.
And our mission today is to cut right through all of that static. We are going deep, really deep, on a single massive strategic shift. A shift signaled very recently by MicroStrategy and, of course, its leader, Michael Saylor. It's a move that, well, the source material we've been looking at suggests is maybe the most significant in the company's entire history.
And one that institutional money is, I think, only just starting to really grasp.
Okay, so what are we talking about here?
We are talking about the green dot signal. For almost 5 years, MicroStrategy's Bitcoin accumulation, that was their foundational phase, was always marked by what the community called the orange dot.
Right, the orange dots.
Yeah.
Standard accumulation, just steady, building, unwavering conviction.
Exactly. But in December, that changed. Saylor posted a chart, and he suggested the strategy was evolving, that we were moving into the green dot phase.
So what is that shift from orange to green? What does that actually symbolize?
Well, orange was the defensive foundational position, right? Acquire and hold. Green. Green means go.
Go.
It signifies a much more aggressive transition. It's moving beyond just simple accumulation to what the analysts we follow are describing as total market dominance.
So it's not just a change in pace, it's a change in operational strategy.
It's a complete evolution, moving from being just a major holder to potentially becoming a central financial entity in the space.
The core thesis we are unpacking today then is it's pretty dramatic. We are dissecting why MicroStrategy MSTR is now being described not just as a tech stock with a Bitcoin balance sheet,
No, not at all.
but as a financial fortress that makes it virtually unkillable. We're going to break down the powerful bull case that is just flying under the radar, and we are looking at the math and the actual mechanics behind it.
And look, this is complex financial engineering we are discussing.
Mhm.
It requires real conviction and a very long-term view. So before we dive into the numbers, we always have to emphasize this critical point from our source research.
Of course.
This deep dive is based on long-term analysis and conviction sharing. The whole point is to make you better informed.
And it is absolutely not financial advice. The stock market involves risk. Understood. So let's jump right into the foundation of this fortress. Section 1. The ironclad defense, built on a $1.44 billion cash shield.
Okay, so let's unpack this, and we really have to focus on the timing and the market distraction that was going on.
Right.
This huge strategic move happened in early December. And it was precisely when the financial news cycle was in absolute full panic mode over the MSCI index rebalancing rumors.
Oh, I remember that. You had analysts just screaming about a potential deletion from passive equity indices, suggesting massive outflows were about to happen.
And focusing entirely on short-term fear. It was all noise.
It felt engineered, almost perfectly timed to make the average person sell low, right? They were worried about index bureaucrats and these technical volatility metrics.
They were looking at MSTR through the lens of traditional equity market rules.
And that was the mistake.
Exactly. So while the masses were totally obsessed with this equity index noise, Michael Saylor executed this. Just masterful, decisive maneuver. MicroStrategy announced it had secured a massive $1.4 billion cash reserves.
Okay, let's stop there for a second, because that is an enormous amount of cash for a company whose entire stated goal is to convert fiat into digital assets.
It's counterintuitive, right?
Completely. If the goal is long-term Bitcoin accumulation, why would you suddenly hold over $1 billion in cash?
And this is where we have to decode the signal.
Mm-hmm.
The immediate, the conventional bear spin, the skepticism you saw flooding the media was entirely negative.
Of course it was.
The critics all said, Saylor must be scared, he's preparing to sell, he's preparing for a market crash, storing cash for an exit.
That's the classic cynical view, right? Cash on the balance sheet signals fear and, a lack of conviction.
But the source material provides a completely counterintuitive interpretation of this. That cash is not an exit strategy. It is unequivocally a shield. It's described as the strongest defensive wall ever built around a public company that uses Bitcoin leverage. And you, the investor, you need to understand the specific mechanical function of this wall.
So how does a pile of cash make a company that holds a highly volatile asset unkillable, especially when you have sophisticated short sellers betting against you?
It ruthlessly destroys the only true risk that MSTR ever faced.
Which was?
Liquidity risk. Think about it in terms of corporate finance and debt structure. If you are a company with fixed obligations, interest payments, debt maturity dates, dividends on preserved stock, you need guaranteed solvency.
Even if your main asset, your underlying asset, plummets in value in the short term.
Especially then. So the cash is held not to prepare for a Bitcoin collapse.
But to ensure that market volatility can never force a Bitcoin sale.
Precisely. Let's use the bank analogy for a second, but let's extend it to corporate debt covenants. If MSTR's debt required the collateral, which is Bitcoin, to maintain a certain ratio to the debt value, a steep, sudden drop in Bitcoin could trigger margin calls.
Or accelerate debt repayment demands.
Yeah, exactly. The company would be forced to sell Bitcoin at the absolute worst possible time to meet those calls. That was the short seller's only real hope.
So they were just betting on a forced capitulation. They were betting that the volatility would expose some kind of structural weakness.
And that $1.4 billion cash reserve completely annihilated that weakness. The details they're staggering. MSTR secured enough cash to pay every single obligation.
Every single one.
Interest on its current debt, preferred dividends, all its operating costs for the next 2 full years.
Without needing to touch its Bitcoin stack.
Without selling a single Satoshi.
2 years of total immunity from market fluctuations. I mean, that's not just financial stability. That's a declaration of war against short sellers.
It is. The entire short thesis hinges on predicting and creating a liquidity event, a moment where Saylor absolutely has to sell. By securing 2 years of runway, Saylor's he neutralized that possibility completely.
So the short seller strategy, it went from being, a plausible bet to
a complete lottery ticket. They can short MSTR, sure, but they cannot force MSTR into bankruptcy or liquidation anymore. It doesn't matter how much FUD they generate or how volatile the market gets. The defense is ironclad.
That genuinely changes the entire calculus. The stock, it transitions from a risky speculative trade where you are always worried about the next margin call to a strategically secured entity.
Exactly.
So let's explore what this newfound stability means for the company's valuation and how it can attract that big money. This moves us perfectly into Section 2, MSTR as the institutional bridge and the justified premium.
Well, the first and I think most obvious result of eliminating the primary systemic risk, risk of a liquidity failure, is that you inherently increase the quality of the equity itself. It raises MSTR's credit rating, in effect, in the eyes of the street.
And this is so vital for institutional players, isn't it? We're talking about the really massive pools of capital, pension funds, endowments, sovereign wealth funds, insurance portfolios.
Trillions of dollars.
And they want Bitcoin exposure. They see the narrative unfolding, but their compliance mandates often prohibit them from holding high volatility, non-custodied, or unregulated assets directly.
Their regulatory and internal frameworks are just incredibly rigid. A pension fund manager can't just go out and buy spot Bitcoin directly.
No way.
And then explain to their board when it drops 50% why they took that high-risk, non-compliant move. They face severe career risk. So they need exposure, but they need it through regulated security.
So MSTR, by creating this massive cash buffer, effectively becomes that highly compliant, regulated security, and it provides pure institutional-grade Bitcoin exposure. It becomes the safe path.
It's the safe bridge. That cash reserve is the institutional validation stamp. It fundamentally changes the entire perception of MicroStrategy. It graduates it from a reckless gamble.
Which is what everyone called it at first. A software company using its cash to buy a speculative asset.
Right. And now it's a calculated, engineered financial machine.
Yeah.
The company has now demonstrated long-term, stress-tested solvency.
I found the language in the source material really striking here. It suggests MSTR is graduating from just a speculative play to a permanent fixture of the global financial system.
It's almost acting as a sovereign entity.
A sovereign entity. That implies just extreme confidence in its long-term viability.
Well, that confidence, it stems directly from the balance sheet mechanics. A sovereign entity doesn't sell its long-term reserves, its gold or its land to pay day-to-day interest.
No, it maintains its reserves as strategic assets.
And by guaranteeing its debt service for 2 full years, MSTR adopted that exact sovereign posture. This signal, It's designed for the largest global capital allocators who think in decades, not in quarters.
Okay, now let's deal with the elephant in the room. The critique that is, the most common and frankly the most reasonable sounding one.
A premium.
The premium. Why should any investor pay a premium, let's say 2 times or 3 times the price of the underlying Bitcoin holdings for MSTR stock instead of just buying spot Bitcoin? Let's take that criticism seriously.
It is a critical question.
Yeah.
And if you approach it with a purely static analysis, just saying MSTR is a Bitcoin proxy, then the premium looks absurd.
It does.
But that analysis completely fails when you realize the fundamental difference between a static asset and an active machine.
Okay, so elaborate on that difference for us.
Okay, if you, the listener, go out and buy 1 Bitcoin today and you put it in a cold wallet, in 10 years, you will still have 1 Bitcoin.
Right.
It's a phenomenal store of value, a passive asset. It's designed to protect your purchasing power against the ravages of fiat inflation. The source states that Bitcoin in a wallet sits there and does not grow the unit count.
It appreciates in dollar terms, hopefully, but the amount of Bitcoin you own is static. 1 is always 1.
MicroStrategy, on the other hand, grows. When you buy MSTR, you are not just buying the Bitcoin it holds today. You are buying equity in an active financial machine that is professionally managed to acquire more Bitcoin over time. It's designed to increase the Bitcoin backing per share. So the premium pays for that active compounding mechanism.
So what specifically are shareholders paying for when they accept that premium? What are the components?
You're paying for 4 key advantages that an individual investor simply cannot replicate. First, the management team, led by Saylor, who has just an unmatched track record of foresight and conviction in this specific asset class.
Sure, that's one.
Second, and this is maybe the most important, you get access to capital markets, specifically the debt and equity markets. MSTR can raise billions at highly favorable terms to acquire Bitcoin.
Right.
Leveraging the investment in a way an individual investor often cannot or probably shouldn't.
That leverage is key. But what about the fees? I mean, ETFs charge management fees, which, they detract from the asset base over time.
And that's the third point, and it's so critical. Unlike an ETF, which charges a management fee that's typically reducing the underlying asset base, MSTR, through its strategy, the accretion strategy we'll get into later, is designed to continuously increase the Bitcoin per share count.
So you're saying, in essence, you are avoiding the management fee and you're benefiting from active growth.
The source materials suggests you are effectively paid a yield over the long term rather than being charged one.
That is a fascinating inversion of the standard ETF model. So the premium isn't a penalty then, it's more like a subscription fee.
Yes.
To a perpetually compounding, leveraged, and now fully insured Bitcoin acquisition vehicle.
Exactly. And it solves the institutional investor's primary structural problem.
Yeah.
How do you gain leverage exposure to a volatile, non-compliant asset?
Through a compliant public security.
That has now proven its solvency against short-term market chaos. The premium is justified by the unique service and the compounding ability of the machine.
Okay, let's turn our attention back to those distractions the market was facing in December, because understanding the noise really highlights the brilliance of the strategy. Section 3, debunking the noise, the capital markets loop versus the index deletion fear.
This was a perfect case study in how the traditional media focuses on really irrelevant technicalities to manipulate retail emotion. The index war, those rumors about MSTR being removed from the MSCI index, that dominated the headlines.
It did. The narrative was so simple. Index funds sell, liquidity dries up, price crashes.
And if you rely on financial Twitter or cable news for your information, that sounds like a death sentence for a stock.
It's terrifying, but it completely misses the entire operational model of MicroStrategy.
It does. And while the media was screaming deletion, the smart money was sending a very, very different signal. We saw Tidal Investments, a serious asset management firm, openly buy $60 million worth of MSTR exposure, right in the middle of this fear campaign.
Right in the middle of it.
$60 million is not retail money buying a headline dip. That is a sophisticated institution making a real conviction purchase. What were they seeing that the headline writers were just completely missing?
They were reading the balance sheet, and they were understanding the core financial engine. They realized that the index war is, like we said, a nothing burger.
Why?
Because MicroStrategy does not rely on passive equity index funds for its survival or for its growth capital.
So, okay, even if the dilution happens and passive funds are forced to liquidate all their holdings, it doesn't really matter to Saylor's long-term plan.
Not fundamentally, no. The capital MSTR needs does not come primarily from equity index funds. The secret sauce, the entire fuel source, is that MicroStrategy runs on the bond market.
Right.
This is the core mechanic that analysts refer to as the capital markets loop, or, maybe more dramatically, the infinite money glitch. Let's pull that apart because I think understanding this loop is absolutely central to understanding the fortress. How does MSTR weaponize the bond market, and why is volatility the key ingredient?
It's all about convertible bonds. So convertible bonds are debt, right? That means they have to be paid back like a loan, but they include a very valuable option. The bondholder can choose to convert that debt into MSTR equity, into stock, if the share price hits a predetermined threshold.
That's the conversion price.
That's the conversion price.
Yeah.
So the bondholders are hedging their debt risk while also getting this massive upside play on the stock's appreciation.
And this is where the volatility comes in.
Precisely. This is why volatility is the engine. MicroStrategy is famously volatile. That volatility is a direct indicator of high potential upside.
Okay.
Because MSTR stock is so volatile, and because Saylor is so convicted, the chance of the stock exceeding that conversion price is incredibly high. This makes the conversion option itself extremely valuable to the bond buyer.
So in exchange for giving them that valuable call option, what does Saylor get?
He gets to issue billions of dollars in debt at unbelievably favorable terms, often at cheap fixed rates, sometimes even at zero coupon interest.
Zero.
The bond buyers are essentially paying for that conversion kicker.
Correct.
So, step one, volatility attracts bond traders seeking that high-value conversion option.
That is just extraordinary. He's paying almost nothing for billions in capital, and that debt is fixed rate, which means inflation is just going to erode its real value over time.
Exactly. Which brings us to step two. Saylor takes that newly secured, cheap, inflation-eroding debt fiat currency and immediately executes the strategy.
He buys more Bitcoin.
He buys more Bitcoin.
Yeah.
And then step three, buying massive amounts of Bitcoin drives up the price of Bitcoin, which in turn drives up the price of MSTR stock because of its leverage to the underlying asset.
And that appreciation and continued volatility then loops right back to step one.
It attracts the next wave of bond traders who are eager to participate in the next round of cheap financing. The cycle is mathematically sound and it's self-fueling. It will perpetually acquire Bitcoin as long as the cost of debt stays low and Bitcoin appreciates.
It sounds like MSTR has figured out how to use the market's own fear of volatility as its primary source of cheap energy.
That is the perfect analogy. The exact mechanism that unlocks billions in zero-cost debt financing.
So worrying about the MSCI index deletion is it's completely missing the point.
Completely. Convertible bond traders do not care about passive equity lists. They care about volatility and conversion probability.
Okay, so let's game it out. Let's assume the deletion actually happens. The passive index funds sell. Who are the buyers on the other side of that trade?
It's simple, really. It's active institutional managers like Tidal who understand this loop. It's dedicated long-term Bitcoiners who view MSTR as the most efficient vehicle. And it's anyone who realizes that this selling pressure is just an opportunity to get cheap shares in the compounding machine.
So the media uses the index threat to flesh out the weak hands.
Allowing the smart money to load up. The actual financial engine is entirely resilient to this kind of index volatility. It's a crucial distinction.
Absolutely. Okay, let's pivot now from the defense and the fuel source to the actual output of the machine. This brings us to section 4, the offensive engine Bitcoin yield and the accretion strategy.
This is why the premium is justified and why MSTR is structurally superior to a simple proxy. It all comes down to the accretion strategy.
Accretion. In this context, that sounds completely counterintuitive to traditional equity finance.
It does.
If a company issues new shares to raise capital, traditional wisdom says that dilutes the existing shareholder base. How can MicroStrategy issue shares and achieve accretion?
You're right to point out how counterintuitive it is. Accretion here is defined specifically in relation to the Bitcoin per share metric.
Okay.
The strategy is this. Every time MSTR issues new shares to buy Bitcoin, they do so only when the market price for MSTR shares is high enough that the new capital they raise allows them to acquire an amount of Bitcoin that increases the total Bitcoin backing a single share.
So they're essentially swapping highly priced paper, their own stock, for a larger share of the underlying fixed supply asset, which is Bitcoin.
Precisely. They are leveraging the market premium on their stock. They issue shares at a massive premium to their underlying net asset value, and then they deploy that capital into an asset, Bitcoin, whose future appreciation potential is believed to be orders of magnitude higher than the immediate cost of the dilution.
So they're diluting the share count just a little bit to enhance the core metric, which is Bitcoin per share.
That's the game.
Could you walk us through a highly simplified, just conceptual example of how that works?
Certainly. So imagine MSTR currently holds 100,000 Bitcoin, and it has 10 million shares outstanding.
Okay, so that's 0.01 Bitcoin per share. Simple math.
Right. Now, they issue 1 million new shares, and they raise $500 million. If that $500 million allows them to buy, say, 60,000 Bitcoin, the total holdings jump up to 160,000 Bitcoin.
And the shares jump to 11 million.
Right. So now you do the new math. 160,000 divided by 11 million shares.
That new figure is approximately 0.0145 Bitcoin per share.
Exactly. So even though you were diluted by new shares, your actual ownership stake in the underlying asset grew.
It went up.
This continuous active increase in Bitcoin per share is the Bitcoin yield that the source refers to.
That is a fundamental difference. It means holding MSTR is, in effect, a savings technology that actively compounds your allocation to Bitcoin year after year as long as the machine is operating effectively.
And this leads us to the really powerful contrast with fiat currency. Think about the Federal Reserve printing money.
Okay.
When the Fed increases the supply of dollars, your dollar buys less over time. It is guaranteed debasement. It's inflation.
Your savings just lose purchasing power no matter what you do.
But when MicroStrategy prints shares through a successful accretive issuance to buy Bitcoin, your share gains purchasing power. It represents more Bitcoin every single year.
It is the mathematical opposite of fiat inflation.
It is. And it's why the source calls it a savings technology wrapped in a stock ticker. It's designed to win the race against monetary debasement.
And this mechanism, this is why traditional valuation metrics just fall apart. I mean, looking at the price to earnings, the PE ratio of a software business is totally irrelevant if the entire purpose of the corporate structure is financial arbitrage.
It is entirely irrelevant. You cannot value it on the legacy software business. You have to look at the flow of energy. MSTR must be viewed as a machine that sucks in fiat currency from the bond market and converts it into digital energy, which is Bitcoin.
And the machine is designed to be permanent. It's designed to function as long as two core realities exist. Fiat currency supply is infinite.
And Bitcoin supply is finite, capped at 21 million.
The math just guarantees the machine will continue to print value for its shareholders as long as those inputs exist. The more fiat that's created globally,
the more fuel the machine has to leverage and convert into scarce digital assets.
So connecting this all back to the initial signal, the green dots. If orange was the accumulation phase built on the faith in this machine, what do the green dots signal about the operational use of that $1.44 billion reserve?
The green dots signal the transition to offense and accelerated accretion. That cash reserve is now operational capital, not just sitting there waiting for a crash.
Right.
They will use the confidence and the stability provided by that cash to aggressively execute even more sophisticated capital market maneuvers, capture more market share, and increase the speed of the accretion.
Meaning, they'll use their newfound credibility and their security to raise debt or equity even more efficiently than ever before.
Yes.
And funnel more capital into Bitcoin acquisition.
Exactly. They're positioning themselves to become what Saylor envisions, the merchant bank of Bitcoin.
A central node of the new financial economy.
Not just a passive holder anymore, but an issuer of digital credit and a key driver of the entire asset class.
That is a phenomenal transition from defense to offense. Okay. Let's move to Section 5 and tie the strategic power into the regulatory macro trends and the ultimate long horizon.
We need to look again at that $1.44 billion cash reserve, but now purely as dry powder. It's offensive strategic capital. And this gives them just immense market power, especially during times of stress.
Yeah, think about the next major market correction. If Bitcoin drops 30 or 40%, the average investor and even many institutions, they're going to be forced to sell or they'll be too paralyzed by fear to act.
But MicroStrategy, conversely, is sitting on $1 billion+ in cash, secured against all of its obligations for 2 years. They become the buyer of last resort.
They're the only whale with guaranteed cash ready to buy the dip aggressively when everyone else is fearful.
And that proactive purchasing ability, that gives them incredible power. They are effectively setting the floor for the market, reinforcing their own position and acquiring more Bitcoin accretively at distressed prices.
This market influence must be the true goal of the offensive phase.
It is. They weaponize stability to guarantee they can act when others simply can't.
Okay, now let's look at the external environment specifically, the changing regulatory landscape. The source highlights the emergence of a pro-crypto era in Washington and this concept of governments potentially creating a strategic Bitcoin reserve.
And this is a massive layer of macro validation. If the U.S. government or any major sovereign wealth fund decides they need to allocate a portion of their reserve to pristine collateral, to Bitcoin, they need a blueprint.
They need proof of concept.
And Michael Saylor, through MSTR, literally wrote the entire corporate playbook.
He proved it works. He proved that putting Bitcoin on a corporate balance sheet is not only feasible, but can outperform virtually every other company in the S&P 500 over the past 4 years.
His financial structure, his debt issuance strategy, his conviction, it's all a validated case study for global governments.
And that regulatory validation completely removes the lingering stigma that MSTR was some kind of outlier or a reckless experiment.
Right.
It proves Saylor wasn't a crazy evangelist. He was simply early, which, in the financial world is often indistinguishable from genius until the market finally catches up.
And this legitimized position then accelerates the next phase of buying, which is institutional FOMO, the flood we alluded to earlier. That $60 million buy by Tidal Investments?
Yeah.
That was the canary in the coal mine.
We're talking about trillions of dollars held by mandates that literally cannot touch spot Bitcoin directly. They need securities.
They absolutely need regulated compliant securities that act as a store of value. As cash yields zero in real terms and traditional fixed income is failing, these funds are desperate for a reliable, appreciating store of value.
And MSTR is the only stock that gives them pure, leveraged, institutional-grade exposure without the regulatory headache.
It is. And the driver at this point isn't necessarily just profit motive anymore, it's career risk.
Oh, that's a great point. No fund manager wants to be the person who has to explain to their clients or their board why they missed the single best performing asset class of the decade.
Especially when a compliant stock solution existed the whole time. The pressure is immense. The institutional FOMO phase is driven by this need to avoid career risk and to play catch-up.
So they ignored Saylor when MSTR looked speculative.
But they cannot ignore the fortress now that it is secured, validated, and demonstrably compounding wealth faster than their traditional portfolios. They will be compelled to buy.
And this all ties back to the sheer scale of the vision. Saylor has always spoken in terms of a 21-year horizon.
Right.
Aligning MSTR strategy with the finite supply of Bitcoin itself, aiming for price targets that sound just astronomical, like $13 million per coin.
Well, when you zoom out, you realize this is not a short-term trade. Saylor is not building a quarterly earnings report. He is building generational infrastructure.
The source describes it as aiming to become the Standard Oil of the 21st century, cornering the digital scarcity market.
So to own MSTR, then, is to partner with this vision, is to have equity in the machine that Saylor built. If you believe in that long horizon, trading your position over some short-term index rumor is just. It's financially illogical.
The market noise is designed to shake you out before the institutional flood arrives.
And the green dots symbolize the confidence that the machine is now fully protected and operating at maximum offensive efficiency to fulfill that 21-year vision. The only metric that matters over that horizon is the Bitcoin per share count.
And that metric is designed to relentlessly climb. This has been a massive deep dive. I mean, complex financial mechanics, strategy, market psychology. Let's recap the core fundamentals that really matter. The key takeaways the listener needs to hold on to when the next wave of volatility inevitably hits.
4 fundamentals define the current bull case, and they're all reinforced by these recent strategic moves. First, and most obvious, MicroStrategy holds the most Bitcoin of any public company on Earth.
Market leader.
They are the undisputed market leader in corporate adoption.
Second, they are masterfully utilizing cheap, fixed-rate debt that is actively being inflated away by fiat expansion, while their core asset base of Bitcoin is appreciating exponentially.
They are weaponizing the very monetary policy that is debasing the dollar. It's brilliant.
Third,
they possess a management team that is fanatically dedicated to one singular goal: maximizing shareholder value through Bitcoin acquisition. There are no distractions of diversification or competing business priorities that plague other large companies.
and fourth, the real game changer announced in December, that massive $1.44 $4 billion cash shield.
And that permanently removes the liquidity risk. It makes the company invincible to short-term volatility attacks and any short seller capitulation bets.
The entire system is now a closed loop.
Self-sustaining and self-compounding. The defense enables the offense, the volatility fuels the debt, and the accretion strategy ensures the shareholder benefits directly, continuously increasing their claim on the underlying asset.
That's a phenomenal summary. But let's close on the theme we started with, volatility, because volatility is still going to happen.
It will.
It's the price of admission.
And the source material is very direct about this. You have to change your relationship with volatility. Don't fear it. Understand it.
Yeah.
Volatility is not risk for MSTR anymore. It is energy. MicroStrategy is fundamentally an engine that converts that energy into wealth via the capital markets loop.
So you, the listener, you have the knowledge now. You can choose to own a static asset that just sits there, or you can choose to partner with a compounding machine that actively leverages market chaos as its fuel.
A machine that guarantees its own survival for years to come, while relentlessly growing your proportional claim on the world's scarcest digital resource.
That is the power of this position. We started by defining the secret language of finance and that green dot signal.
And you are now one of the green dots.
You see the future, you understand the mechanics, and you know the short thesis has been defeated by the balance sheet.
We are the ones who see the long horizon.
And we are not selling.
Not a chance.
That is it for this deep dive. We hope this has given you a clearer, more convicted view of the strategic landscape. Until next time, look for those green dots.
See you then.